Ted Turner was masterful at that, is masterful at that. He owns more land in the US than I think anyone, definitely in Montana, but he didn't buy it when everybody else was in the craze of buying. He bought it when everybody else was liquidating because they were in a cash crunch. That's when he bought CNN. He actually sold his signage company, and when they hit a cash crunch, bought it back for less than he sold it for. Like, that's making money on the buy. This is where the biggest savings are, and this is where the attorneys come in. It's reclassification. Reclassify your income. There's 4 ways to do it. The first way is we want to turn active income into passive income. So there's a few ways you can turn active income into passive income. Reasonable salary test. You can set up an S corporation, pay yourself a reasonable salary, which isn't what you're worth, but what someone else would do the job for, and pay the rest in distributions. Now, make sure you use the reasonable salary test. Some people go, oh yeah, they're a solopreneur. They have no employees. They're like, I'm going to pay myself 30% salary, 70% dividends, and guess what? If you get audited, they're going to say, what? This doesn't make any sense. You're the only employee. But someone like Warren Buffett, who's not, he's not actually showing up to the companies that he buys. He's implementing that with, other people going and do that. He could take almost no salary or take a lower salary than even his secretary and take the rest in, stock or distributions, and therefore is going to have more passive income, and that passive income will save you as high as 15.3% or as little as 3.2 once you've maxed out FICA and FUTA. And even after 250 grand, it saves you an extra 3.7 on top of the 3.2 because Obama had initiated a success tax that came in at that point. So you're saving anywhere from 3.2 to 15.3 just in how you take your income. Maybe it's a building that you office in and you have an LLC that owns that, and then you just charge yourself the highest reasonable rent for that so the income's coming in through there through 1099 instead of W-2. You're just reclassifying how the income comes to you to save on tax. The second thing is anytime you can move from ordinary income to capital gain. So let's say you do business internationally. If you have international customers, you can set up an international sales corporation, and if those customers pay you to your international sales corporation, it's a capital gain. Capital gain might save you 15% in tax, right? Or let's say that you have a substantial business, and there's substantial risk with that business. Well, I have a captive insurance agency, so I have my own insurance company that I put cash into pre-tax. If I don't have an insurance claim, I can take that money out capital gain instead of ordinary income. That's an 831B. Now you have to do those right because number one, if you set those up, you are more likely to get audited if you own a captive than if you don't. So it does increase your likelihood of audit. And tons of people abuse those. They put the wrong type of assets in it. They invest outside of the spectrum that they're allowed, and those are the ones that get in trouble. And there's plenty of people that do it right, and they don't have problems. So they do have a bit of an interesting reputation because there was a time where the government was thinking about shutting them down. But since that time, they went from 1.1 million that you could put into it to 2.3. So we've actually seen, there's ways to do it right, which means a feasibility study and the right companies. I had a client call me and say he was going to set one up for $5,000 through an Indian reservation company, and I was like, okay, come on. Like $5 grand, that would be nice to save the money, but sometimes saving money costs you a bundle, right? Sometimes the most expensive advice is free advice, so I talked him out of it. But those are just a few examples of moving from ordinary income to capital gains. And look, everyone here should get intimately familiar with Section 199A. 199A changed the game on how we can pay ourselves and get that pass-through deduction. Now, originally, when Trump was talking about it, it sounded like anyone with a corporation was going to move to a 15% tax rate. But then they came down to 2 equations, and the greater or lesser than this, and I would have to take a whole 2 hours just to explain the damn thing. But the reality is it saved me a boatload of cash last year. I actually increased salaries for myself and some of my employees and paid a little bit less in distribution because it gave us that pass-through deduction. So you want to learn about 199A. If you don't know about it, you're overpaying tax. All right. Third, I like this one, tax-free. Very exclusive to real estate owners and business owners. You get this tax-free opportunity. One of my favorite things is a charitable remainder trust. We just had a client who's selling his business. Fortunately, we got a hold of him early enough before he had a letter of intent and the business was being sold. It's due to close next week. And so his savings doing a charitable trust is $2.5 million. Plus he gets a tax deduction, which we're still figuring out what the assessment is, but it's somewhere around $900,000 to $1.1 million is the range that he's in. He'll be able to have 5% and 50% to 50% is like the high end, depending on underlying assets he can invest inside of this charitable trust. When he dies, the charity keeps whatever's left over, but he gets to live off that income for the rest of his life, and the full amount with the tax deduction he can take that year plus 5 years later against half of his adjusted gross income. It's called the charitable remainder trust. There's a bit more to it than that, but I just want to give you a sense of that when you understand that, you can do that with real estate. So it's pretty cool because if you do it right, you can actually give money away, spend more money during your lifetime, and if you use the Rockefeller method, replenish that wealth tax-free back to your heirs because of the insurance. So it's a pretty cool concept. So that's just one example on the tax-free side. And then fourth is tax arbitrage. So tax arbitrage is what I started with here. I mentioned it. And so tax arbitrage looks like this. Who in here knows about historical easements? Historical easements are, harder to come by, but amazing if you can. So since there's a lot going on in Dallas and Austin, because I know we got some people from Austin here, like development rights have gone up massively in value. And so what a lot of these cities value is the historical preservation of what already exists. I'm in a historical building in Salt Lake called the Hardware Building, built in 1902. And a historical easement allows you to donate the historical facade. The historical facade means that you cannot tear that building down and build a bigger building. So you're forfeiting the right to be able to redevelop it, but what you can do is still rent that out, cash flow that, but the Forest Service of all places deems whether it's worthy or not as a historical easement, and you can get major tax advantages. The best I've seen, the tax advantage paid for the building. And then they still got to rent it out. So it's harder to find historical easements, but if you do, that's tax arbitrage. You're actually getting the asset, and you're getting this major tax advantage. It varies based upon how valuable the development is, how valuable the property is. If you go to Austin, they're just building so many things, not highways, mind you, but just buildings, because who needs, traffic's fun. So, but it's more valuable there because it is highly, but if you go to my hometown of East Carbon, Utah, nobody's gonna pay anything for a historical easement because nobody wants whatever's left there and buildings. So it really depends on the city's value and how much development's going on. I actually own 10 acres on a mountain not too far from here, and I was thinking about selling it, and then for a while I was like, well, maybe I'll do a conservation easement. So we had a client in September, had a bunch of land in West Texas, and he hated the land. He's like, there's nothing there. He just couldn't sell it for what he wanted to get for it. And so we just did an assessment. We're like, hey, is there sand on the land? He's like, yes. We're like, oh, well, sand is required for fracking. So what if we just send out an appraiser and we figure out if you were to develop that land, what it would be worth if you sold that sand as now a fracking opportunity. We're not going to ask you to do it. We're just going to find out what it's worth, and what it was worth was a 6.5 to 1 tax deduction, which meant he got back, that's the deduction. So looking at a credit, it's still like 2.5 to 1. For every dollar he spent on the land, he got $2.50 in tax credits through being a conservation easement. He'll never sell the land. It will never be developed, but he got a major tax advantage greater than what he paid. So there's syndicates that do that. I just want to warn you on those. I did one for the first time last year. If they don't do it right, it could go bad in an audit. What I mean by that is when you're now putting money in and you have unrelated investors, right? And you go in and if they don't do a full vote and say, do you want to sell this land, develop this land, or donate the rights to the development? Well, ours, it was 82% wanted to donate the rights, right? And then they have to do some other specific things, like we did multiple appraisals to determine what the value was, and then you got to pick which appraisal you want to use. And so if they don't do all those things properly, one person getting audited and didn't do it right will trigger an audit for pretty much anyone else in that easement. But if you already own the land and you never want to develop it, like I have a client that has a place in just outside of Colorado Springs, Colorado, and he's got like 500 some acres. It's a big ranch, but he's got 31 acre lots on it. I said, are you ever going to develop it? He said, no. And I said, let's do a conservation easement on those. This can get you a major tax deduction, and you didn't never plan on developing it anyway, so might as well get that benefit today. That's a conservation easement. Okay, so historical easement, conservation easement, those are two examples. The thing that I did first, I did this in 2006 before I even called it tax arbitrage, was I bought a huge art collection. I bought from two artists a ton of their art. But I signed an agreement that I wasn't going to sell it on the open market, so they sold it to me for 25 cents on the dollar of what the actual appraised value was. Now, after I held that for 3 years, it went from book value, which is what I paid, to appraised value, which is what it was worth, and then I donated it to museums, and that donation got me back $2 for every dollar I spent. Okay, so that's tax arbitrage. I look at tax arbitrage as kind of your last resort, or if you can add it on to the deals that you're already doing. But why would you ever go buy a vehicle that you don't want to get 37 cents on the dollar when you could do this and get $2 back for every dollar you spend? So, now if you want the vehicle, just buy the vehicle. That's cool. I bought a truck last year, and I'm from a small town, so it means a lot to me. Now, the people in the small town don't consider it a truck because it's a Raptor. And my wealthy friends just think I'm white trash, so I don't really fit in anywhere. You know, but I love my truck anyway. So, look, this is just one of the 4 areas of efficiency. So we began with mindset. We just talked about playing not to lose. I don't think there's a lot of people in this room in the playing not to lose segment. I think there's more people in the playing to win. But at what cost? Have you defined success for yourself? Is the juice worth the squeeze? Like, what about quality of life at the forefront? And how can you be more abundant because you've really taken care of self-care and yourself and enjoying life along the way, building a life you love. The second thing was money. We talked about 3 main segments of money. The first one being more efficient, which was the IRS, which I gave you the framework for. The second one being interest. The third one being investments. And the fourth one being insurance. We have, that's a couple days to go through all of that. Then we talked about this economic independence framework. The economic independence framework is, first, recover cash, plug the leaks. Second, engineer wealth. Figure out what your economic independence number is. Reverse engineer what's the fastest way to get there. For some, it's paying off loans. For others, it's buying real estate. For others, it's growing their business. The third thing is you become a cash flow investor. Everything that's not creating cash flow for you, turn the cash flow button on, right? Have that start to present cash flow rather than accumulate. The fourth thing is you scale your business. Scale business revenue, whether that's cycle of creation, whether that's investing in the right people in your business, whether that's adding more value to existing customers or reaching more. But scaling business is the unparalleled advantage of economic independence. And the fifth thing to economic independence is make it count. Enjoy life along the way. You are your greatest asset, so you invest in yourself. You take care of yourself along the way so you have plenty to give and you're not exhausted. And so make it count is really living that legacy. So recover cash, engineer wealth, accelerate investment income, scale business revenue, and make it count. That's how you get economic independence. It takes 3 to 7 years. It doesn't take 30 years. Then the next part, as I said, how about making money on the buy? Becoming a cash flow investor, buying when everybody else is losing so that you're making money on the buy. Ted Turner was masterful at that, is masterful at that. He owns more land in the US than I think anyone, definitely in Montana, but he didn't buy it when everybody else was in the craze of buying. He bought it when everybody else was liquidating because they were in a cash crunch. That's when he bought CNN. He actually sold his signage company, and when they hit a cash crunch, bought it back for less than he sold it for. Like, that's making money on the buy. You can read an article in the New York Times written by Malcolm Gladwell that features him called Predatory Investing. The third thing was cycle of creation. Taking and profiting from ideas, using your market, using the very end users to be the people that fund what you're up to so you're not left with loans and all the time it takes to go get that. So that's pre-selling. And the fourth piece we spent a lot of time in, which was legacy, which I won't use your name because I don't have permission, but someone came up and said, hey, here's what we're going to do for our family on legacy. We're going to just show your video. And that way the idea is coming from you, Garrett, not from us. Dude, this is exactly how I do things with my wife. I go, all right, if I tell her, it's going to be a stupid idea. But who do I know that can tell her that that's going to be brilliant, right? And I just get them to tell her. And then, like once I had a client that I said, hey, let's go hear him speak. And they're like sharing the content that I was helping them write a book with that I gave. And she's like, are you listening to this? I'm like, yeah. Are you? You know? She's like, this is brilliant. I'm like, yep. I thought so too. So that's the framework. So there's a few thresholds, and I'll go through several of them here. So the first one is, the first, simplest, most important threshold is rudimentary, but it's you gotta pay yourself first. So every time you're taking personal income, you're taking 18% off the top, you're setting it aside into what I call a wealth capture account, which is just a money market, savings account, checking account. It's just separating it so it's not commingled with your business funds, it's not commingled with your personal funds. And you've got to get that to 6 months liquidity on personal expenses. That's a big benchmark, right? When it's at 6 months, I actually take and put all of that into cash value insurance now on that 18%, not into that account. Now 18% I can break down why if we need to later. It's 3% by 3% by 3% because of taxes, inflation, planned obsolescence, propensity to consume, technological change. There's a reason behind it. But once you have that, now your main focus is economic independence. So the basic economic independence of just covering your expenses through cash flow. There's 2 ways to do it. One is with your assets. The second is with business. But with business, I'm talking entrepreneurial income. So I have a lot of entrepreneurial income because I create content for organizations that pay me a licensing fee. And they pay me that every time someone uses it and month by month, so that creates a recurring revenue. I filmed it once. I'm still moderately involved, but I'm not daily involved in it. I can go to Italy for 2 months and still have income come in from that. If that income stops, that's not entrepreneurial income. That's just active income, right? So you want to get that to a 1-to-1 ratio, ideally a 2-to-1 ratio. That would even be the next benchmark. The benchmark after that is when you have $1 million of net income or $2 million of liquid net worth or $7 million of total net worth. So 1 million net income, 2 million liquid net worth, meaning you can get to that money within a week, or 7 million, it can be tied up in businesses. Now you are open to a portfolio bank. Now you can work with private banks and portfolio banks, and you're gonna have a different set of rules around lending, access to money, building out private structures, eliminating fees, so that becomes another benchmark. As you start to get into these concepts, you'll hear, I think later this afternoon, that's when asset protection becomes even more essential. Now, I look at asset protection in multiple dimensions. Insurance as one line of defense, corporate structure as another line of defense, domestic asset protection trust as another line of defense, and liquidity as yet another line of defense, right? Captive insurance. So it's like it becomes more comprehensive as time goes on, and you might just start with a basic corporate structure, but then you might expand and have a holding company with multiple corporations as you build bigger net worth, right? So that just becomes something that I think that you have to look at least annually. Like I just always have my estate planning meetings already on the books to meet once a year so I don't blow it off or forget about it, because I've just met people with estate plans, they've got 3 kids since the last time they did an estate plan. I'm like, what good does that do? Or they have an estate plan and nothing's deeded into it, so I'm like, that doesn't really help. So I think that just creating automatic habits and rhythms become critically important as well.